Till age 50, I had no savings. In fact, I had a one-third share of a house. If you see the bank account, maybe 5 to 6 lakhs would be lying, that in the savings bank account. It was only that my friend's question, maybe it is a God's voice, is what I am thinking, because it came out of the context and the question was very clear. What will your wife and children get if you die today? The next day, I went out to the nearest insurance advisor, insured myself for a term insurance of 1 crore. So I answered my friend's question. But then the realization struck, I cannot keep on working like this. So somewhere I have to stop. So at the age of 50, I calculated how much I require for my son's higher education. I also calculated my retirement corpus. I had set myself 10 years, 50 years, 60th year I wanted to retire. But after 57, or one day I just saw my investment account. Already it has reached past the retirement corpus. The next day I went to my boss and said, I fire you. Can we roll? It's already rolling, huh? Oh, sorry. Basically, if you see my childhood, after finishing BCom, I wanted to go into teaching line or in sales line. But my father thought there was no money in either. So I was pushed into CA rather than I took CA as my profession. So personal finance was not taught to us either in the graduation or in CA also. CA taught us how to evaluate an investment opportunity. We went deep into it. But the art of budgeting your own income and arriving at savings and how savings can be multiplied was never taught, right? And during the working life, my money was going in frivolous expenditures and instinctive buys, which at that time looked very fancy, but after a week of use, it was also never used. So a lot of junk was there in my house. And we used to go to a lot of restaurants, we used to travel, we had a few cars with drivers, and we, of course, dined in good restaurants, and we went to movies together. So we had a good lifestyle and good time, good travel. But the realization that we have to save did not strike me until the age of 50. So after 50, what changed? I first set aside the amount for savings. The rest only is left for expenditure. Whatever is left within that, we have to adjust our expenditure. And also, I had several advantages when I started this journey. Number one, I was having a very high salary. It was about 3.5 lakhs per month at that time. And even at that rate, I was not saving anything. That is the beauty of it until I realized. Then 60% of it I saved. So I said on 7th, our salaries used to be credited. 7th, every SIP will go. On 8th onwards, whatever is left in the bank account, I used to spend. That is because my salary was very high. And we are vegetarians, especially at that time. We have taken a vow that we will also be not having onion and garlic, which to date we are maintaining. So I could say majority, and whatever funds come by way of bonus or unexpected windfall in the profit of some investments, I used to reinvest. When that happened, my whole financial life turned from negative to highly positive. The second thing is my educational background, as well as my experience, taught me how to evaluate an investment from the return and risk point of view. So I took high risk, I should say, because I put all of my investments in equity mutual funds and equities, which if you take any planner today, they would say it is foolish. I would say it's a calculated risk because I knew the returns and risk. I'm sure I have not taken any risk if my time horizon is 10 years. And secondly, as soon as I started investing, the next year, 2008 came. And with that, there's a global depression, the fall of Lehman Brothers, the whole market was down, and my own investment, which is entirely in equity and equity mutual funds, went down by 80%. And after 5 years, it more than quadrupled. In fact, last year was like that. Last year, the market was going down. A very good opportunity. If somebody has started his wealth creation journey last year, it's a jackpot, right? That is the reason why my journey planned for 10 years shrank to 7 years because of the 2008 and 2009 when the equity assets were very cheap. So God also helped me. I had some ground rules for wealth creation. Number one is be disciplined, and be persistent. Number 2, if you see red in your equity portfolio or in your mutual fund portfolio, do not panic. Invest more, not to balance. Some people used to balance. I don't say don't balance. If you are sure that your equity selection is perfect, your equity mutual fund selection is perfect, then put more money into it. Many people are challenging when I say 13% CAGR in my article. But I have a definite worksheet with the verifiable facts, okay, taken from reputed sites like Yahoo Finance for the price only. The rest of the research is done by me personally, right? Basically, if you have selected your mutual fund, over the last 20 years, the average returns is above 17%. If you take 15 years, it is still over 17%. If you take the equity, even if you don't have the expertise, you select what you think as very good equities. For example, select the top 4 private banks. Actually, banking sector, if you have invested equally, over the last 20 years, you have got 21.45%. If you take the NBFC's basket, it has returned a 24.5% CAGR. Let us take FMCG companies. They have given 19.97% combined, right? So auto companies, that has given 20.59% CAGR. Then why people are not making so much of money in equity? It is because of lack of persistence, lack of discipline, right? Mutual fund returns at a glance. We say we will take mix of large and mid cap, flexi cap, and small cap. Mostly many people crowd their mutual fund portfolio with 30, 40, 15 or 20 mutual funds, not required. Just 2 or 3 asset categories have given unequivocally above 17%. The very poor performing fund has given 16.19% CAGR. Is a very good asset return. That is the reason why I am saying equity and equity mutual funds create wealth more than any other asset class when you are starting out to create your wealth. How about selecting equity mutual funds or equities? Rolling returns is the first. The longer the period, the more thorough the research is, because in a 15-year period, the share market would have undergone many ups and downs. So how the mutual fund has managed in terms of rolling returns, right? That is one part. But the fund giving the highest returns is not the fund to invest, because there's a risk associated with it. What are the risk parameters we check? Standard deviation. If you go by the lower standard deviation, again you will choose a fund with low returns. So we have to fix a parameter. Okay, if the standard deviation is within this parameter, say 7%, I will select that fund and compare the rolling returns. Similarly, we check for beta, how it reacts to market volatility. Again, we don't go for the lowest beta fund. Same error can happen. We fix, okay, if the fund is having 0.8 or 0.9 as the beta, that is enough for me. Then we have got a ratio called Sharpe ratio. It actually measures the risk that a fund is taking to create returns. So what is the return it is creating per unit of risk it is taking? Everything I fix a parameter. If it falls within that parameter, that fund is selected. And there is also a ratio called downward upward capture, up or down capture ratio. That is, in case of a market downturn, how much down it has gone. That is captured by upward capture ratio. So if it is more than 1, it should be a good fund. But greater the ratio, the chances of selecting that fund is more likely. The fourth parameter we consider is maximum drawback. In the entire life of the fund, when the market was down, what is the maximum drawdown of your capital? Is it 30%? Is it 20%? How much capital it has set you back by? This is another important consideration. Everything has to be done in moderation. It's just like conducting an orchestra. Okay, everything has to be balanced in order to get the optimal returns. It's just not the mathematical calculation and going by the lowest. It is balancing the risk and returns. So high return funds need not necessarily be the fund that you have to choose. That is equity mutual funds. In terms of equities, there are 6,000 shares, right? How to make it to a smaller denomination? First, when you invest in equity, it has to be liquid, right? If you want money, you have to get out of it. So the first Nifty 500 companies. So from 6,000, I brought it down to 500. Who is having the positive cash flow from operation and it is expanding? That is the company I will choose. From 6,000, these companies will come down to 50 or 40. And then we apply other parameters like PEG to check whether the price is right. Okay. And especially we should choose companies in the mid cap or small cap because large cap has already run its course, which is having a good corporate governance. How to check whether there is a good corporate governance? It is only cash flow because it may be having high profit, negative cash flow, which means they have adjusted the balance sheet and profit and loss account. There is one more this thing which is a cash conversion cycle. If the cash conversion cycle is increasing, that means the company is hiding something. With greater profits and greater business, cash conversion cycle should come down. And related party transactions. If there are high related party transactions, then there's poor corporate governance. Then sudden increase in auditors' fees also. We consider that along with other indicators to see whether good corporate governance is there or not. So cash flow from operation expansion and the cash flow from investing, whether they are investing for their growth. A company which does not invest have no room for growth, right? It will stagnate or it will be at a steady phase. It will not go into an exponential growth. A company which invests in infrastructure and other things is likely to grow. So these are the things that we consider in a multibagger, how to choose a multibagger. And it would be interesting for you to know, we always constantly research. So one of the recent research is that there are 40 companies which has given returns of more than 20% in the last 1 and 2 years. And they have given more percentage considering 3, 5, 7, 10 and 15 years. I cannot spell out the exact stock name, but I can give you the sector name. One is bank, private bank, not public bank. Another is NBFCs. Because these two are the natural choices. I have always believed in banks and NBFCs because people pour their money to them and make them rich. We compete with each other taking loans and making the banks and NBFCs rich. Second is defense. Though they are of recent origin, have always returned in the last 5 years above 25%. The solar related companies as well. These are defense and solar is of recent origin, but IT, bank, NBFCs, then consumer durables, these have always been given maximum returns in the last 10, 15 and 20 years. And we have got the data to back it. If you take my own portfolio after retirement, I have only one debt mutual fund. That is also not a complete debt mutual fund. It is hybrid, conservative hybrid fund. Is the only debt mutual funds I have. I have a large amount of money in that. I have only 4 funds in equity mutual funds. Then I have got 20% in government guaranteed securities. Average return of which above 8.5. How to achieve that 8.5? Bonds, government guaranteed bonds are there. They give above 9%. Mix it with SCSS. SCSS is Senior Citizen Savings Scheme. It is 8.4%. So if you mix and match these, your average is likely to be 8.5%. And if you pair it with the conservative hybrid, it will go up to 10%. Your debt and government yield will be 10 to 11%. There is 10.55 is my conservative hybrid fund yesterday's return. Why we say taking a housing loan for purchase of a house is harmful. Usually what happens, a 50 lakh house is selected, 10 lakh is the down payment, 40 lakhs you make a loan. After 20 years, what has happened to that house? What is the value of that house is only 2.33 crores. What you have bought at 50 lakhs 20 years back is 2.33 crores. Maybe a little more also, 3 or 4 crores. So what is the CAGR? It's between 8 to 10 or 11% depending on the locality. If it is apartment, it is less. If it is a standalone building, residential building, it is a little more. If it is a commercial property, it is a little bit more. But see, what exactly if you have invested in mutual funds, the same 40 lakhs, 10 lakhs you have actually gone for a house on leasing, so no rent is there. So you made a 10 lakhs advance in order to lease a house and invested mutual funds for 40 lakhs, it would have multiplied to 12 crores. If you have invested the same in a bouquet of private banks, then the value of your investment is 24.37 crores. If you have invested in NBFCs, it is 40.09 crores, right? So what is the value of your house which you have purchased 20 years ago at 50 lakhs? You compare that return with what I have told you, I think the decision is very clear. Core philosophy is start early, retire early, retire rich. A person who start early in their life, retire also early in that life. So you know what retirement brings, unlimited happiness. Because you don't have the responsibility of money. It is already coming through your passive investments. So if you want to achieve unlimited happiness, start early.
Obviously, every kid thinks that, I have to do something for my mom and dad. We didn't actually need to give any money back home, for our parents' survival. So that was a good impact on us brothers, because we were, taking those kind of risks at a very early age, like I told you before. But for my dad, I think, dad and mom, I think, it was a very relaxed, non-stressful way of living life.
I'll just add one more thing to it. The ability to take risk comes from a position of strength where you're able to let go of, certain monetary incentives, right? The kind of cushioning that comes with a financially independent parent, right, is something very fundamental to risk taking, at least for the next generation, right? So to be able to take that leap, the kind of cushion that a financially independent parent provides, I think without that, the life would be very difficult as an entrepreneur, probably even impossible, right? So I keep telling this to my friends also, that I am fortunate to have parents who have built that particular cushion and not have that responsibility of bringing money on a month-on-month basis to support either your life or parents' life, right? This creates a room for that risk taking, right? So that's been a wonderful thing for us.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.